Welcome to This Explainer. Today, we're demystifying market cycles and the golden rules of investing. I am super excited to guide you through this material because, let's be honest, the stock market can often feel like this totally exclusive club with a language entirely its own. But by the time we wrap up today, you're going to understand exactly how market cycles work, and you'll walk away with a strategic toolkit used by literally some of the greatest investors in history.
Okay, so let's just dive right in by challenging your financial psychology right off the bat. Imagine I give you a choice. I'll hand you $100 today, or I'll give you a brand new Mercedes a year from now. Which one are you taking? I mean, obviously the car, right? You'd be crazy not to. But what if I offered you $100 today versus $100 next year? Well, in that case, you'd absolutely take the cash today because there's zero return for waiting. And boom, in just a few seconds, we've basically defined what it means to be an investor. You are an investor if you believe the future is worth somewhere between that $100 and a new car. It's really all about how much the future could be worth in exchange for just a bit of sacrifice today.
To see how this investor's mindset actually pays off in the real world, let's consider a young fireman who decides to save a pretty meager $1,000 a year for 50 years. That is roughly $83 a month, a super modest amount, right? He starts at age 20, puts his head down, and consistently sets that money aside until he retires at age 70. So the big question is, does it really matter where he puts that money?
Well, the mathematical difference between keeping cash stuffed under a mattress versus investing it in the stock market is frankly staggering. If our fireman just hid that cash away, earning 0%, he'd retire with exactly what he put in, $50,000. If he chose a slightly better route, like bonds or real estate growing at around 3% to just keep up with inflation, he'd have a very respectable $116,000. But if you look at the strategy on the right, by investing in the stock market, which historically has returned around 9.8% over the last century, his meager $1,000 a year absolutely explodes into over $1.35 million.
And this brilliantly illustrates exactly why starting early is crucial. Like Albert Einstein famously put it, compound interest is the eighth wonder of the world. Time is literally the secret ingredient here. If our fireman had started saving that exact same $1,000 a year at age 15 instead of 20, so just 5 years earlier, he would yield over $2.2 million by retirement. Think about that. That's nearly an additional $1 million, just for starting 5 years sooner. The earlier you put your money to work, the much harder it works for you.
All right, moving on to Section 1, Bull versus Bear Markets, Mapping the Terrain of the Stock Market. So, to navigate this volatile terrain without totally panicking, we first have to define the two main market moods. Understanding these two environments is absolutely essential. The main thing to grasp is that while a bull market feels amazing, a bear market actually means stocks are significantly discounted for long-term buyers. So, a bull market happens when stock prices rise 20% or more from recent lows. The economy is growing, jobs are plentiful, and investors are feeling super optimistic. It feels great to look at your portfolio, right? But then we have the bear market. This is when prices drop 20% or more. It's driven by pessimism, fear, maybe rising interest rates or inflation. When you're right in the middle of a bear market, it can feel incredibly scary. But if you have a long time horizon, a bear market is actually a total gift. It means high-quality companies are basically on clearance.
If we look back over the last century, we definitely see some terrifying drops. Take the Great Depression, where the market lost 79% of its value, or the dot-com bust in 2000, where it fell 54%. But look at what happens in between all that fear. The peacetime boom starting in 1949 saw the market absolutely skyrocket 267%. Historically, stocks spend way more time in bull markets than they ever do in bear markets. We're talking bull markets averaging over 4 years, while bear markets typically wrap up in less than a year.
So all these up and down fluctuations, they're just natural cycles, which means bear markets are totally normal, just part of the process, and definitely not a reason to panic sell. The value of the businesses you own is going to fluctuate. That is just the everyday reality of the stock market. The absolute worst thing you can do when things point down is react emotionally and sell your shares to avoid further losses. That kind of panic selling literally turns a temporary dip on paper into a permanent loss of your hard-earned wealth.
Which brings us to Section 2, the market timing trap, and exactly why guessing doesn't work.
Man, this is such a huge pitfall for beginners, trying to time these market highs and lows perfectly. It is so tempting to think you can somehow outsmart the system, right? Like you're going to sell right before a crash and buy right back at the bottom. But obsessively analyzing charts to time your entry and exit is 100% a losing game. Actually, back in 1984, academics literally compared stock market guessing to a coin flip, and the data totally backs that up. Studies show that even professional forecasters, these are people whose entire full-time job is to predict the market, guess the market's direction correctly only 48% of the time. You'd literally be better off flipping a quarter.
Because you honestly cannot predict the bottom of a bear market, a strict buy and hold strategy is going to vastly outperform panic selling every time. The research is crystal clear on this. Missing just a handful of the market's absolute best days over a decade can drastically hurt your overall returns. And guess when those best days usually happen? Yep, right in the middle of or immediately following a brutal bear market crash. If you try to time the market and pull your money out, you are almost certainly going to miss that explosive rebound.
So let's jump to Section 3, the golden rules of investing. Here's our strategic playbook for building wealth.
Since timing the market is a trap, we need a reliable strategic toolkit to confidently navigate any cycle, just like legends like Warren Buffett do. First up, surviving volatility requires strict discipline. You've got to keep investing steadily, don't let fear derail you, and please never put all your eggs in one basket. By using something called dollar cost averaging, which really just means investing a set amount of money on a regular schedule, regardless of what the market is doing, you automatically buy more shares when prices are cheap and fewer when they're expensive. Plus, by diversifying across different sectors, you make sure that if one industry takes a major hit, your entire portfolio doesn't just go down with the ship.
Moving on to Rule 1. Think long-term. You must leverage what's called time horizon arbitrage. This is exactly what Warren Buffett did when he bought American Express during their whole kind of crazy vegetable oil insurance scandal. In the 1960s, American Express took a massive hit because they accidentally insured barrels of vegetable oil that turned out to be filled with mostly water. The stock totally tanked. Wall Street was panicking. But Buffett, he looked way beyond that short-term distress. He knew the core business was still incredibly strong. He thought long-term, bought the heavily discounted stock, and ended up making a fortune.
Rule 2 dictates that good companies make good investments. Like Warren Buffett famously says, you aren't just buying ticker symbols blinking on a screen. You are buying tangible pieces of real businesses. You want companies that don't have to constantly beg to borrow money just to survive. You want companies with a unique advantage or a moat that competitors can't just easily copy. Look, if you fill your portfolio with wonderful companies, your portfolio is going to do wonderfully over time. It's that simple.
Then we have Rule 3, which comes straight from Benjamin Graham. Buy with a margin of safety. This basically tells us to buy businesses at a price low enough that even if our assumptions are slightly off, we won't lose our shirts. Say you calculate a stock is really worth $50. You don't go and buy it for $49. No, you wait until the market is having a terrible day, like during a bear market, and you scoop it up for $30. That $20 gap, that's your safety net. It protects you from the totally unpredictable nature of the future.
And finally, Rule 4 reminds us that investing based on a TV tip or some random rumor isn't investing at all. It's just gambling. You absolutely must do your own financial homework. The legendary investor Peter Lynch famously said, "You have to know what you own and why you own it." If you buy a stock just because a talking head on a financial network yelled about it, you are not going to have the conviction to hold on to it when the market inevitably takes a dip. You have to understand the products, analyze the financials, and truly believe in the long-term vision of that company. So, what does this all mean for you? By embracing these cycles instead of fearing them, the future of your wealth is entirely in your own hands. We've seen that bear markets are really just clearance sales on great companies, and that jumping in and out of the market is just a total fool's errand. The real, life-changing money is made by simply letting compound interest work its magic over decades. So ask yourself, how are you going to apply these golden rules to your own portfolio? Are you going to keep acting like a speculator, hoping to get lucky, or are you finally ready to build real wealth like an investor?